You know, in the hotel business, there's one number that really matters more than almost any other. And it's not about luxury, it's not about five-star reviews, it's about survival. It's that exact point where you stop losing money and finally start making it. Today, we are going to find that magic number with break-even analysis.
So let's start with the most fundamental question a hotel manager can even ask. Forget about profit for a second, forget expansion, forget the new fancy amenities. Just focus on this one thing. How many rooms, night after night, do you absolutely have to sell just to keep the lights on? Answering this question, well, that's the foundation of your entire operation.
I think this is the perfect way to frame it. Break-even analysis isn't just some boring accounting task. It's your strategic compass. On one side of that line, you've got all the risk, and on the other, you've got resilience, the stability you need to actually grow. Knowing exactly where that line is, that changes everything.
So, what exactly is this survival number? Let's get a crystal clear definition, shall we?
The break-even point is this moment of perfect equilibrium. All the money that's coming in from your guests is exactly equal to all the money going out to run the hotel. You're not profitable yet, no, but here's the crucial part. You're no longer losing money.
The concept is just beautifully simple. Every single room you sell below your break-even point is putting your hotel in the red. But the moment you cross that line, that's where the magic happens. Every single room you sell above that point is pure profit. And that, my friends, is the goal.
Okay, so we get the concept, right? Now, how do we actually calculate it? Let's build the formula, piece by piece. I promise it's way more straightforward than you might think. First up, we've got fixed costs. These are the bills you have to pay every single month, no matter what. Doesn't matter if you sell 1 room or 100 rooms. We're talking about things like rent, management salaries, insurance premiums. They're the predictable, solid foundation of your costs. Next up are your variable costs, and these are the polar opposite of fixed costs because they are directly tied to your occupancy. For every single room you sell, you're going to incur these costs. We're talking about the laundry for the linens, those tiny bottles of shampoo, the cost of cleaning supplies, you name it. The more rooms you sell, the higher your total variable costs are going to be.
And finally, we have the revenue piece of our puzzle, ADR, which stands for average daily rate. It's simply the average price you get for a room. You just divide your total room revenue by the number of rooms you sold. This is the income that has to cover all those costs we just talked about.
And here it is. This is how all those pieces fit together. You take your total fixed costs and you divide them by this really important figure called the contribution margin. That's the part in the parentheses, your ADR minus your variable cost per room. It's basically how much profit from each room sale contributes to paying off those big fixed costs.
All right, theory's great, but let's make this real. We're going to plug some numbers into this formula for a typical small hotel and just see what happens.
Okay, here's our scenario. We've got a small hotel with monthly fixed costs of $100,000. Their average daily rate is $150, and for every room they sell, it costs them $50 in variable expenses. These are our 3 key ingredients.
So let's run the numbers. First, we need that contribution margin. We take the $150 from the room rate, subtract the $50 variable cost, and that leaves us with $100. That means every sale contributes $100 toward those big fixed costs. Next, we just take the total fixed costs, that's $100,000, and divide by that $100 margin.
And there it is, 1,000. This hotel needs to sell exactly 1,000 room nights a month just to cover its costs. The 1,001st room, that's where the profit finally begins.
But what does 1,000 rooms a month actually mean, on the day-to-day basis? Well, let's assume it's a 50-room hotel. That means they need to sell an average of about 34 rooms times every single day. All of a sudden, the front desk manager has a clear, actionable target for every single shift. See how powerful that is? Okay, so you have your number. Now what? Well, this is where break-even analysis goes from being a simple calculation to being a really powerful strategic weapon. This number informs so many of your decisions. For pricing, it tells you your absolute floor. How low can you go? For forecasting, you can model different scenarios. What happens if occupancy drops? In a crisis, this is your survival threshold. And for your sales team, it creates a clear, data-driven target to hit every single day.
But let's be really clear. Breaking even is just survival. It's the starting line, it is not the finish line. The real goal is to use this knowledge to intentionally plan for profit.
And here's how you do it. You just tweak the formula a little bit.
Let's say you want to make $20,000 in profit this month. You just add that target to your fixed costs, and then you run the exact same calculation. Now you know how many rooms you need to sell not just to survive, but to hit your specific profit goal.
Okay, before we finish up, let's just reinforce the core message here and cover a few important little caveats to keep in mind.
Look, this model is fantastic, but it does have its limits. It assumes your variable costs are stable, which they might not always be. It doesn't account for your hotel's physical capacity. I mean, you can't sell more rooms than you have. And crucially, it excludes those really big ticket items like capital expenditures or debt payments. Those have to be planned for separately.
But the main takeaway here is this: break-even analysis isn't just for the accountants. It is a fundamental strategic tool for any leader in hospitality. Knowing this number gives you control, it helps you manage risk, and frankly, it helps you sleep a lot better at night knowing exactly where you stand. And that leaves us with one final and really critical question. You've seen how it's done, you understand why it matters so much, so now it's time to apply it. Go find your fixed costs, your variable costs, and your ADR. What's your hotel's magic number?